All right, you have a tale from the trading desk for us. And you've had
Yes.
2 beers already, so this is going to be good.
This is my third, the tall boys. Yeah, so it might be good. Let's have a let's kind of reminisce back to a time when trading desks were fun.
Oh,
Because this is
they have they have it's a new generation.
yeah, the banks have no longer been fun, and I'm going to tell you how it was when I was a wee youngin and I had to go to school with snow up to my chest. No, I'll tell you how it was when I was allowed to trade on a desk, and we'll talk about the days, the Wild West days at, I won't name the bank, but we did a lot of proprietary trading. And so we were actually not allowed to do tax trades. It's complicated. It doesn't matter. But the reality is that we would go and take large positions the other way because we realized that if we couldn't gross up and earn the tax, well, we could figure out ways to arb it the other way. So we would go and we would sell swaps on the Toronto 35 or the Toronto 60 index. And so what we would do was we would go and give people the returns of the index, and they would go and we would have to give them an interest rate component, like an interest rate swap against it. Right. The long and short of it is that we had a huge cash balance that we had to deal with. And so when we had this cash balance, we would have to go and invest it. And I would be stuck with this, and I would phone up our money market desk, and I'd say, listen, I want to do CDOR, which is kind of the Canadian equivalent of LIBOR. And I would go, I had to achieve CDOR on a specific day. So I'd have to, like, whatever the day the swap rebalanced, I'd have to go and achieve CDOR. And these buggers on the money market desk, they would always, like, try to chisel me, and they'd be like, CDOR -2. And I'd be like, screw you. Like, this is free money. Like, you should be just taking it as CDOR. And, they're traders, and they would try to chisel me. And I said to my boss, I said, listen, you know what? This CDOR crap, like, let's just trade it ourselves instead of dealing with the money market guys. So I started saying, like, I'm going to trade BAX futures, which is kind of like Eurodollar futures for Canada. Next thing you know, I'm tossing around like 1,000 lots of BAX futures because, like, we got like this big, huge book in this, and we're doing well, and we're no longer getting skimmed by the money market guys. So we think this is great. We're no longer getting picked off. We're getting more efficient. And I say to my boss, I say, you know what? Like, this is like banker acceptance, but like we can do better if we go out and take a little risk. So we go. This is what it was like, Patrick. So we go.
Yeah.
We start buying asset-backed paper, which inevitably in the 2008 problem actually ended up being a real problem, like a real problem. But this was in the 90s and was a long way from this occurring. So I started buying some asset-backed paper because instead of just CDOR, I could go pick up CDOR +10, +15, and I was like, when you all of a sudden have like we were hundreds of millions. I think we were almost $1 billion swap. So we were, had this credit that we were earning. If we could go pick up 15 basis points, that was real money for us. So next thing I know, I become money market's best customer because I'm buying all this shit. Like, you name it, I bought it. Like, I was just like, because all of a sudden we had like $1 billion that we had to invest. And so one day, this is going great. We're picking up all this yield, and my big boss is in a meeting. And they're talking about a specific issuer that they are all worried about because it's, I can't remember why. There's probably some fundamental reason for it. But me as a equity trader, I looked at this stock and I go, I'm buying 90-day paper. Look at the stock. It's fine. There's no reason to ever worry about this. Let's just buy the 90-day paper. It's +30 or whatever. Let's go. And so he's in his risk meeting, and they're going through it, and they're saying, well, bonds has got 5 million. Money market's got 10. That's good. We managed to sell that. But equity derivatives has 42. And the boss, my big boss, says to me, he says, no, that can't. No, it doesn't say to me. He says to the committee, he says, no, that can't be right. We don't trade that. And they're like, aren't you inventory, blah, blah, blah. And he says, yeah, that's us. And they go, well, you have 42 of this. I think it was New Court Credit, which was a name that eventually got in trouble, so they were right to be worried about it. But I just looked at it as like 90-day paper; it's going to be fine. Anyways, Next thing I know, I get this big screaming like the Flintstones, like when Fred calls for Wilma, and it's Kevin, and so I'm like going and I'm getting all this shit about like the fact that this young 20-something trader has put all this risk on the bank's balance sheet without thinking about it, and Patrick, I don't blame them. As an old guy now, I wouldn't let some punk buy this, either. But at the time, it seemed like I don't know what you guys are all worried about. Let's go. So I had all these rules. Patrick. So I was only allowed to buy R1 mid. I was only allowed to buy 50 million, and I had all these rules. And then what happened was 1998 hit. And 1998 with long-term capital, it was just a crazy shit show. And it ended up being everybody was selling futures, and I was buying futures and selling stock, and I was earning credits. And the thing about it is when you're doing this and you're doing this in size, you're actually the rate that you're going to earn is actually really important.
Right.
Well, usually you just let it float in the overnight or whatever, but I went and realized that I could go and I could buy all these credits that were in the previous, they were trading at CDOR plus 10 and 15, but all of a sudden they were trading at plus 50, plus 70, plus 100 in some cases. And I remember them coming to market with $250 million of GE paper. And this is why I like to talk about GE.
Yeah.
And GE paper, like back then, it was like the best, credit that you could buy in credit. Like I think it was the only AAA still, and it was trading at like plus 60, and they were coming to market with $250 million of Canadian paper. And my money market guy phones me and he says, "Listen, they got $250 million." I said, "Listen, I'm only allowed to take 50. I wish I could take the whole issue, but I'm only allowed to take 50, and I only could take 50." And but I just remember that it was such a great, exciting time to be alive, and it was so much fun because they just let these young kids like me trade a million crazy shit like this, and it was actually
that doesn't happen anymore.
It doesn't happen anymore. And listen, I don't blame them. As an old guy, I would never let a young punk like me buy all this stuff, but it sure was fun at the time, and we were just minting it because at the like nobody was buying. There was absolutely nobody left to buy, and we had a bank balance sheet, and we were just like minting it, and the arbitrages that were just monstrous, Patrick. And people don't understand when the shit really hits the fan and when the markets get inefficient, how stupid stuff can get on big size.
Right.
Anyways, that's my
because the liquidity becomes a factor, right? And
it's because I was the only buyer.
Well, that's what I mean.
Like a bank balance sheet.
It's just that when you're that big of a size,
and the other thing is that I was sitting there as with a bank balance sheet, and I could go and sell vol. And when it went to 20, I could sell it. When it went to 25, I could sell it. When I went to 30, I could sell it. And all the hedge funds were the other way. The hedge funds, they might have sold it at 22, and then all of a sudden it goes to 30, and they all had to cover.
Right.
And I would just be like, I could give it to them every round. So I would just be like, okay, let's just do more. So it's not very smart, and it's one of the advantages the banks have. And obviously in '08, if you started too early, you got completely rammed. And not only that, there was a question of whether those banks would exist. But I just wanted to kind of give a little picture of what it was like being.
Oh yeah, no, that's crazy. Like that's where the TED spreads and everything blew out in 2008, right? Like just banks couldn't trust other banks. It was like a crazy period. But anyway, a kid like you back then in '98 would have no clue.
No clue.
But like long-term capital must have completely changed all that, though, right?
Well, no, that was during long-term capital.
Yeah, that's what I mean.
And those were why those things blew out. But we thought that this was the craziest shit we'd ever seen, and there was no way it would ever happen again. And I'll tell you one thing. Long-term capital was just a walk in the park compared to '08.
No, yeah, for sure.
Like, go look at the TED spread. Go dial it.
Oh, it's ridiculous. Like, it was like 4.5, 450 basis points or something.
I had a buddy that had a swap with Lehman, and they unwound it. And in the midst of between it settling and the stock settling, they went bankrupt, and he wasn't sure whether he was long or short the stock. And it wasn't just like on 100 million or something. It was a big, big number.
Wow.
Anyways,
well, thanks for sharing, Kev. That was an awesome story.
Too many beers.
Too many beers. All right.